Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at fixed income markets and their performance for the first half of the year, having taken a look at equity market performance last week. Now, it's been quite a roller coaster ride as well for bond investors in this first 6-month period of 2020. And again, much of the driving force has been, in fact, COVID-19. So let's take a look firstly at some of the fixed income markets and what some of the performances would have been. And locally, some of the major fixed income indicators would have been changed significantly in response to the fallout from COVID-19 rather. The repo rate and primary reserve ratio or primary reserve requirement would have been significantly reduced by the Central Bank of Trinidad and Tobago in conjunction or in close dialogue with the Ministry of Finance. And that repo rate, as mentioned, would have been cut back in mid-March from its traditional level of around 5% to 3.5%, so a 1.5% decrease in that benchmark rate. Now, for those of us who may not be familiar with the repo rate, it is an indicator broadly of where lending rates should be, and that would have enabled a decrease in prime lending rates by commercial banks as well, falling by a similar 1.5% on average across all commercial banks, so making lending conditions a bit more accommodative for potential borrowers or existing borrowers. The primary reserve ratio, primary reserve requirement was also cut from 17% to 14%, so a 3% decrease, and that would have freed up an estimated 2.6 billion TT dollars to enable more liquidity for banks to be able to increase their lending. So those double effects would have had a quite significant impact on excess reserves in the financial system, with excess reserves actually increasing from 5.5 billion in December 2019 to almost doubling, an 83% increase, in fact, to 10 billion in its, as mentioned in its most recent monetary policy announcement back in June of 2020 by the central bank. Headline inflation has remained fairly subdued, and that has been around 0.4%. The last recorded figure officially was March of 2020. So some fairly stable inflation figures there. So with improved lending conditions, lower interest rates, higher excess reserves, and fairly stable headline inflation, one would expect that bond yields for investors would have come down on average, meaning the return that one would expect on government yields from our government-issued bonds. That, however, has not been the case. There's actually been a very marginal increase in treasury yields for over that 6-month period. As we can see, the June 2020 yield curve in that yellow line has pretty much hugged, and in the current environment, to be fair to say, is not being too socially distant from the December 2019 treasury yields. And just as one example, we can see at the 10-year mark, the average yield on a 10-year government bond at the start of the year, or at the end of December 2019 rather, would have been around 4.5%. That yield is now just climbed just around 12 basis points, or 0.12% to 4.66% in the most recent iteration of the government of Trinidad and Tobago yield curve. So again, the yield curve or government bond yields have been moving slightly counterintuitively to what would be expected with a lower interest rate environment and higher liquidity environment with subdued inflation. So what can local investors expect in the months ahead, at least at the local level? Well, there is expected to be increased government bond issues, though most of these have thus far been targeted to institutional buyers and not necessarily via public auction, as would have been the case with the National Investment Fund being the most recent notable public offering in terms of the bond issuances, and that was way back in 2018. We can continue to expect persistent excess liquidity, particularly with the fact that the primary reserve requirement can be further reduced, and inflation for now seems fairly moderated, and that should lead to fluctuating TT dollar bond yields over the next couple of months. Now, internationally, it has been much more pronounced in terms of bond price movements, although you can't really see it in this particular graph. Investment-grade emerging market bonds, on average, have returned just around 2.5% and in the positive region after being in the deep negative at the earlier part of the year. And high-yield bonds have actually been retained a negative 2.3% year to date, and they were much more of a negative position as well earlier in the year. Now, this picture doesn't tell the whole story. When we take a look at some names or bond issues that may be more familiar to Trinidad and Tobago investors in terms of the USD bonds piece, just as an example, the Trinidad and Tobago 4.5% 2026 bond started the year at 107, traded as high as 108. At the peak of the crisis, hit a low of $84 per $100 face value, and is currently trading at 102 per $100 face value. Now, this is not typical of how bond prices move, and in fact, the price of the bond would have been trading more in similar vein of volatility to a stock price, and that has been the case for most Trinidad and Tobago US dollar bonds, in addition to the general bond piece for investors. So this is probably gives a better picture for investors of what would have taken place. What can we look forward to in the coming months? Well, in terms of the international bond outlook, that crisis of confidence, economic crisis, would have been met with a response from US Federal Reserve officials by slashing rates to near zero and extraordinary market support, including bond buying programs, which would have really de-risked international bond markets, in particular US bond markets, and led to bond investors seeking better yields in a near zero interest rate environment. So that has certainly supported international bond markets. However, that should be taken with a pinch of salt, because rating downgrades credit rating downgrades have increased, and Trinidad and Tobago's international credit rating has been no exception, having been cut by Standard & Poor's and maintained by Moody's, however, placed on a negative watch. Rising bankruptcies, as would have been observed, particularly in the US over the past few months, is also going to be another feature. So international investors or investors of bonds in the US dollar space should continue to be selective and favor quality above all in the coming months. Better to earn a little bit less and ensure that your principal has a better chance of being preserved over the next coming few months. So that's it for this week's Bourse Report. For more information, give us a call at 226-8773, email us at invest@boursefinancial.com, or check out our website. And if you happen to miss our webinar, which spoke in more detail about the outlook for bonds and stocks in the year ahead, locally and internationally, you can catch that replay on our Facebook page, YouTube channel, as well as our website. That's it for this week's edition. Have yourself a wonderful investing week. This has been the Bourse Report.